want to start off by wishing everybody a happy new year. And as the year gets started, the markets have been bracing for the Federal Reserve to raise interest rates at least 3, if not 4 times this year. And the conventional wisdom is that these rate increases are somehow bearish for the price of gold. And that's one of the reasons that the price of gold hasn't gone up. It's still been hanging out around $1,800 an ounce. Well, first of all, the fact that the price of gold hasn't gone down, despite this almost universally held belief that these rate hikes are somehow negative for gold, is in and of itself a positive sign. After all, if gold's not going down, well, eventually it's going to go up. But the more important factor is to understand that not only aren't these projected rate hikes a negative for gold, they're actually going to be a positive. So let me explain. First of all, the rationale for why rate hikes is bad for gold is actually pretty simple, because gold doesn't produce a yield. So there's always an opportunity cost when you own gold, and that is the yield that you forego by not owning dollars, because if you have dollars, you can put them in the bank and earn interest. But if you just deposit your gold into a safe, you don't earn anything. In fact, you may have to pay somebody to store your gold. And so you give up the interest. Well, interest rates have been 0 for many years, and so there has been no opportunity cost to own gold. And so 0 interest rates have been supportive of gold. And the fear is, well, if the Fed removes those supports by raising rates, gold's going to crash. Well, it's not going to happen, because you have to understand the difference between nominal interest rates and real interest rates. Because when you're talking about an opportunity cost, the interest rate has to be real. And by real, I mean above the rate of inflation. So, for example, if you look at the government's way of measuring inflation, the CPI, flawed as it is, if you look at all of 2021, consumer prices rose by about 7% during the year. Now, even if the Fed actually follows through with all of the rate hikes that it's projecting, it's talking about slowly raising interest rates in 1/4 point increments until at the end of this year, they're at 1%. And they'll continue the process in 2023 until at the end of 2023, we're at 2%. And supposedly, this 2% rate of interest represents a huge headwind for gold, because it's an opportunity cost, and a lot of people that are in gold are not going to want to be in gold when they can get a 2% yield on their cash. Well, the whole idea is absurd on its face, because if you accept a 7% inflation, even though the actual rate of inflation is probably 15% if the government measured it accurately, even if you accept their inaccurate measure, if you agree that prices are rising by 7%, what that means is the dollar is losing 7% of its purchasing power every year. Now, in exchange for that, you're going to be able to earn 2% in interest to offset the 7% that you're losing to inflation. You are still negative 5%. Negative 5% is not an opportunity cost. Nobody wants the opportunity to lose 5%. So if you're giving up a 5% loss, you've given up nothing. Nobody who owns gold, because they don't want negative 7%, is going to suddenly decide to sell their gold because they're happy with negative 5%. The only way you will sell your gold to take advantage of higher interest rates is if there's actually something to take advantage of, which means you need an interest rate that is higher than the inflation rate. Let's say the government were planning on raising interest rates to 10%. Now that might be a problem for gold. If inflation is 7 and interest rates are 10, that's positive 3. That means by owning gold, I'm giving up 3% in real interest that I could otherwise earn. But if they're just talking about raising rates to 2%, that's nothing. I'm going to stay in gold to avoid a 5% loss. The opportunity cost is not owning gold, it's owning US dollars and losing 5%. yes, you get 2% back, but inflation is 7%. So what the Fed is talking about doing is too little, too late to derail the gold bull market. In fact, it's going to initiate, I think, the next leg up when the markets come to terms with this reality. But also what the markets have been focusing on is this Fed's fight against inflation, right? Because gold is an inflation hedge. Well, now after years of denying that inflation existed and then pretending that it was transitory, now the Fed has finally acknowledged that there's a problem and it's going to solve it with these rate hikes. And so people think, well, if the Fed's going to fight inflation, that's negative for gold because, the Fed is going to win this fight and therefore the inflation problem is going to be solved, and so I don't need to own gold. Well, when the markets realize that these incremental tiny rate hikes are not nearly enough to stop inflation, because the only way the Fed could stop inflation would be to get out in front of it. You need interest rates that are higher than the inflation rate to actually reduce it. What the Fed is talking about doing is reducing the amount of gasoline that is pouring on the inflation fire. That still means the fire is going to get bigger. Even if it gets bigger more slowly, it's still going to get bigger. But I have a feeling that it may get bigger even faster. And when the markets realize that these rate hikes aren't doing any good and that inflation is getting worse, that's another reason to buy gold. In fact, what is probably going to happen is these rate hikes, while they're not big enough to stop inflation, they are big enough to prick the bubble in a lot of these speculative assets that have been inflated with 0% interest rates. Because as I've been saying, when you develop an addiction to a certain amount of monetary heroin, even if you get monetary heroin but you get a smaller dose, it's not enough for your habit. And I think that's going to happen in the markets. You're going to see a lot of stocks coming down. This is going to be problematic. There could be some financial blow-ups as a result of widening credit spreads and falling asset prices. And ultimately, it's going to bleed into the real economy. We are not just headed for inflation, but stagflation. And in the face of that, the Fed is ultimately going to do an about face. It's going to start cutting interest rates again and restarting the QE program, even though the inflation problem has gotten worse. Now, of course, when that happens, gold is going to go ballistic. But between now and then, take advantage of the misperception in the market that these rate hikes, if they actually come, are bearish for gold. That's keeping a temporary lid on the price of gold. Eventually, reality is going to blow that lid off. But in the meantime, buy yourself some gold. In fact, maybe even better, buy some silver as well, because the impact on silver has been even greater than the impact on gold, and therefore they're giving away silver at an even cheaper price than they're giving away gold. This sale is not going to go on forever. When you get a gift horse, don't look it in the mouth. Just take advantage of it. And what we are getting right now is the mother of all gift horses from a market that totally doesn't understand the implications of what's going on at the Fed and what it portends for inflation, the dollar, and the price of gold. Thanks for listening. And again, have a happy and prosperous new year.